Ladies and gentlemen, good day and welcome to the Q4 FY23 earnings conference call of Electrosteel Castings Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Diwakar Penge from Ernst & Young LLP. Thank you, and over to you, Mr. Penge.
त्यांनी आपला कॉल होल्डवर ठेव. अब जिस व्यक्ति से बात कर रहे हैं, उन्होंने आपके कॉल को.
Participants, please stay connected. Diwakar sir, please go ahead.
Sorry. Yeah, good afternoon, everyone. Again, I think sorry about the call drop. Welcome you to the earnings call of Electrosteel Castings Limited for Q4 and FY23. Today we have with us the management represented by Mr. Madhav Kejriwal, Whole-Time Director, Mr. Ashutosh Agarwal, Whole-Time Director and Chief Financial Officer, Mr. Pankaj Poddar, Executive Director and Chief Marketing Officer, and Mr. Gaurav Samani, who is the Joint General Manager of Finance. Before we started, I'd like to remind you that the remarks today might include forward-looking statements and actual results may differ materially from those contemplated by those forward-looking statements. Any statements we make on this call today is based on our assumptions as on date, and we have no obligation to update the statement as a result of new information or future events. I would now like to invite Madhav Kejriwal, the Whole-Time Director of Electrosteel Castings, to make his opening remarks. Over to you, Madhav.
Thank you. A very good afternoon to all, and on behalf of the entire management team of Electrosteel Castings, a very warm welcome to the company's Q4 and FY23 earnings Concall. Before I get started, I'll take a quick minute to introduce myself. I am Madhav Kejriwal. I'm part of the promoter group, and I'm currently overlooking the sales and marketing functions of Electrosteel Castings. My journey with Electrosteel began in 2014 as a management trainee on the shop floors of the Jharkhand steel plant. After gaining some understanding of the production, I joined the sales and marketing team, where I was a part of the team which was successful in penetrating the company's wire rod product reach in the domestic markets. As on 2009, I took over as the executive director of Shikala Asti Pipes, and since have gone on to look over the entire sales and marketing, both domestic and export. Before we go into the company's performance and business, I'd like to introduce Electrosteel's business model for the benefit of the market participants who are listening in to us for the first time. Electrosteel has 6 decades of rich experience and is the pioneer of ductile iron pipes and fittings in India. We have a rated capacity of 6.8 lakh tons per annum, which makes us the industry leader. We also have a very strong brand recall in the export markets. Our DR pipes and fittings are laced with internationally acclaimed certificates, including international global certificates. ECL has a presence in over 110 countries and 5 continents, and we have managed to make good, deep inroads in the export market with presence in Western Europe, UK, USA, Middle East, Asia, and Africa. The company has a well-diversified product portfolio which includes ductile iron pipes, ductile iron fittings, ductile iron flange pipes, and restraint joint pipes. Additionally, ECL manufactures cast iron pipes, metallurgical coke, sponge iron, cement, ferrosilicon, pig iron, and power. We have 5 technologically advanced integrated manufacturing units in Kharda, Bansberia, Haldia, Elaur and Srikalahasti. The company continues to meet and win domestic and export customers' trust owing to a strong R&D framework with its quality right the first time and robust quality management system proposition. We at Electrosteel command a leadership status both in the domestic market with a 25% market share and a 65% share of exports from India. With strong entry barriers to the industry, market dominance, promoter enterprise, one-stop solution provisions for water infra needs, R&D focused back, huge industrial tailwinds in domestic as well as exports has made Electrosteel amongst the preferred partner for ductile iron and allied products. More than 20,000 water supply projects have already been implemented in India and abroad with DI pipes and fittings made by Electrosteel Castings. Moving on to Electrosteel Castings FY23 performance, it gives me immense pleasure to share with all our stakeholders that the company has recorded its highest ever top line of 7,013 crores, registering a 37.6% year-on-year growth in FY23. This has been fueled by a domestic business growth of 41% and an export growth of 29%. Our volumes stood at 710,000 tons, which is a 19.5% growth year-on-year. The flagship program of Honorable Prime Minister, the Jal Jeevan Mission, which aims to connect every rural household with tap water connections, has achieved up to 61% of its nationwide target. Around 8 crore rural households have received safe drinking water till FY23. Of India's total 1.9 crore rural households. ECL continues to be amongst the key beneficiaries of JJM schedule due to accelerated spending by the government for meeting its Har Ghar Jal target in 2024. Additionally, ECL will continue to benefit from the government's increasing attention towards the country's water infrastructure needs with initiatives such as Jal Jeevan Mission, Amrut 2.0. ECL has also undertaken capital expenditure in 2 phases to meet the growing demand of water infrastructure. Phase 1 got completed in August 2021 and is operating at 100%, and Phase 2 is under progress. The ductile iron pipe industry is a sunrise sector as it is globally accepted and is the best suited pipe for water transportation and sewage. DI has an inherent edge on other pipes as it has a long shelf life of 70 to 90 years. It has an easy installation process, low maintenance cost, greater tensile strength, along with the ability to handle both internal and external pressure. Keeping these things in mind, the company is seen to be in a sweet spot and is poised to benefit from the growing water infrastructure spent both in domestic and export markets. I would now like to hand over the floor to Mr. Ashutosh Agarwal, the whole-time Director and CFO, for taking you through the Electrosteel Castings FY23 financial highlights.
Thank you, Madhavji. Good evening and a warm welcome to investors fraternity joining Electrosteel Castings Q4 and FY23 result discussions. I would like to start our discussions in 4 parts. Part 1 is Q4 results and performance of the company. Company recorded its highest ever quarterly results and EBITDA. ECL total income grew by 13% year-on-year to 1786 crore, owing to a strong and DI pipe volume growth of 8.4% during the quarter. Company reported EBITDA of 233 crores. EBITDA margin stood to 13.1%. Margin was slightly lower on account of higher prices of coking coal. PAT stood to 101 crores. PAT was impacted due to higher interest cost during this quarter on account of increase in interest rate and higher utilization of funds due to steep rise in raw material prices. Second portion of my statement is about the financial full year performance of the company. Company registered its highest ever revenue during the year and EBITDA and PAT also. ECL total income was surged to 38% year on year to rupees 7013 crores due to strong DI pipe volume growth of 20%. Additionally, both domestic and export grew by 41% and 29% respectively. EBITDA grew by 14% to 819 crores. EBITDA margin was 11.7%. PBT was 433 crores. PAT was 335 crores. About the balance sheet highlights, the net debt to equity was 0.43 times as on March 23. The ROCE and ROE is 13.1% and 11.3% respectively as on 31st March 2023. I would like to highlight something about the capex plan also. Company plan to ramp up the existing capacity of 6.8%, 8 lakh tons to 9 lakh tons by the year 2025. In order to fuel the cost capex plan, ECL has incurred a capex of 610 crores. Out of that, 170 crores already spent and 440 crores is about to be spent in 2 years' time. Company is sitting on the cash balance of around 600 crores as on 31st March 2023. With this, I would like to open the floor for the question answer session. Thank you very much.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Participants, you may press star and 1 to ask a question. The first question is from the line of Ashok Patel from Molecule Ventures. Please go ahead.
Sir, congratulations on a very good set of numbers. Sir, my question is regarding our ongoing dispute petition which was filed regarding one of the coal block investments done by us earlier. So in the past, we have never mentioned in notes to accounts that about a specific conclusion coming through. But recently, as you have mentioned, that government has allotted that particular mine, Parbatpur mine, to JSW Steel. So now, do you see some more visibility in terms of the dispute getting resolved? If yes, what would be the new timeline as per you for the same? And what amount are we expecting?
Good afternoon, Mr. Ashok. So first of all, just to clarify, this is not a dispute. The coking coal mine was reallocated in 2015, and since then we have been waiting for the compensation to come in. So as rightly said, the mine has been mine was put for auction, and JSW Steel has been declared as the winner. So as per the rules, the new allottee should pay to the prior allottee. So now things are moving well, and as was briefed in the last call as well, that the mine, the nominated authority had, appointed a valuer to conduct the valuation of the mine. So bills and everything have been verified, and now I think it's a matter of time, and we are hopeful to get some positive response So once that comes in, we will definitely inform everyone.
Sure. So before this compensation is cleared, JSW cannot go ahead and use that mine, right? Is that correct understanding?
Yeah, the understanding is correct.
Okay. And sir, regarding, I understand that independent valuationer would be assigned, but what would be our expectation from the company side? How much are we expecting from the same?
So there's no point of expectation because as per the rules, whatever capex that we have incurred and is appearing in the audited annual report is the amount which needs to be paid. So if you go by that logic, whatever is coming in the annual report is supposed to be received by us.
Sure. But it won't be less than that, even if the valuationer, independent valuationer assigns a value lower than that.
Mr. Ashif, we cannot jump on that because since this is a matter with Ministry of Coal and the government is involved, so you can understand that we will have to go by what decision is taken by them. Having said that, we'll have to wait for some more time. When we have already waited for 7 years, we'll have to wait for some more time to get the clarity.
But do you feel, sir, in FY24 itself, the deal can we expect the proceeds in this financial year itself?
Yeah, we are hopeful that it should happen this financial year.
Sure. And sir, all the best for the same. Sir, my last question is basically what sort of steel inventory do we generally maintain on our books? Just for in order to understand more in terms of our gross margin bit.
So, Mr. Ashif, see, last 2 years, our working capital requirement has gone up, and it's mainly on account of increase in capacity. As Mr. Madhav had pointed out earlier, that we had increased the capacity by 100,000 tons in August 2021. So, in last 2 years, because of capacity, the inventory position has gone up. Also, the second point is that the commodity prices had gone up, because of which the value of inventory had gone up. But if you see from FY22 to FY23, our inventory has come down by 150 crores, in spite of volumes going up by 1 lakh ton. And as far as the policy is concerned, we have two main raw materials. One is coking coal and one is iron ore. So coking coal we import from Australia, and we have to maintain a significant inventory just to ensure that there's no problem in production process. So we generally maintain 4 months of inventory of coking coal, and iron ore can vary from 2 to 3 months. But coking coal can come down to 3 months also gradually. We aim to bring it down to 3 months. Sure.
So, sir, given the fact that coking coal has been correcting off late, it is down from almost $400 to around $250 to $275. So, can we expect, assuming even if we hold 1 quarter of inventory, Q2 onwards, our gross margin should be significantly better than at what point we are standing right now?
See, as far as margins are concerned, we are hopeful that margins will improve from here on. But how much we cannot comment on that. And you are right that coking coal prices have corrected and have moderated in last 1 month, 2 months or so. And that is why there will be a dual effect. One, the margins would improve, and second, the cash flows would also improve because inventory would also come down. But yes, from maybe second half or maybe the remaining 9 months would be in a better shape, much better shape.
Thank you. Asha, I'll request to join the queue again for a follow-up question. A request to all the participants, please restrict to 2 questions per participant. If time permits, please come back in the question queue for a follow-up question. The next question is from the line of Vikas Singh from Phillip Capital. Please go ahead.
Good afternoon, sir.
Good afternoon.
Yeah. So my first question related to the competitive intensity. Satwana plant most likely would start very soon, which is very closer to Srikalahasti plant. So how do you see that this is impacting your margins, or is there enough orders for both the players in the south to enjoy a good order book and margins? So just wanted some thought process on that.
Sir, there is ample demand in the market at the moment, and the same is applicable specifically for the southern market. The coming up of the Satwana plant does not seem to pose any form of issue for us in terms of our margins and our market presence.
Understood, sir. So my second question pertains to our margin. If I look at the quarter-on-quarter basis, basically, it's still kind of a flattish thing. So just wanted to understand, since the commodity prices, especially coking coal, have fallen significantly, when do we expect that to reflect? And our understanding was that since pipe was a fixed margin contract, so 6 months back when the coking coal prices or the pig iron index was pretty high, you would have got a very high margin. Orders, if you execute now, should have given you very high margin. So just wanted to understand this lead lag effect, when it would start reflecting, and when do we expect our margin to pull up?
Mr. Vikas, so see, the commodity prices were up, and because of which the realizations, the cost was passed on, the higher cost was passed on, and hence realizations were up. So if you see, we have been able to maintain our absolute numbers. We have been able to report higher EBITDA. In terms of margins, it's very obvious that it will come down. It will soften a bit compared to the previous years when the denominator was lower. So this year the denominator has increased, because of which the margins have got impacted. Going forward, since the coking coal prices have moderated, we feel that margin would start moving up again.
Understood. Sir, did our mix, our order mix basically has a fixed price order? We have also started to shifting to a kind of some portion variable, considering the last year had a very bitter experience. So just wanted that how we are booking the new orders now.
So the industry trend remains to be on fixed prices, please.
Thank you. Vikas, I'll request you to join the queue again for a follow-up question. The next question is from the line of Vijay Agarwal from Federal Bank Limited. Please go ahead. Vijay, may I request you to unmute your line from your side and go with the question, please? Due to no response, we move on to the next participant. Next question is from the line of Karthik Muthuswamy from Trident Advisors. Please go ahead.
Yeah, thanks for your thanks for taking my question.
Karthik, you are not audible.
Yeah, can you hear me now?
Little better.
Yeah. Yeah, thanks for taking my question. How do you look at this demand supply panning out over a longer period, say 10 years? Because if I look at 2009 on the
Karthik, sorry to interrupt you, but your voice is not clear at all.
Okay.
Is it possible for you to speak through the handset?
Yeah. Can you hear me now?
Yes.
So, how do you look at demand supply over a 10-year period? Because if I look at your numbers in say 2009, you used to make around 2.5 lakh million tons of DI pipes. Now you're heading towards 9 lakh tons. And if I were to look at capacity additions being announced, there have been multiple players wanting to enter the space. In the Western region, a couple of new players have announced, a couple of players in the East who are wanting to put up new capacities. And if you look at places like, if you look at programs like Jal Jeevan Mission, you guys say 61% is done. So is there a structural overcapacity this industry is heading to, not in the near term, but if you take a 10-year view? And in that context, why are we also adding capacity? Or you think, despite the completion of the Jal Jeevan Mission, you think there will be enough orders coming in, given particularly the state of state government finances, this kind of large capacity addition over the last 10 years, and the ongoing capacity addition can be sustained?
Sir, the way we look at it is that India is at the cusp of a infrastructure boom, and if you see any past trend of countries or continents which have seen a similar trend, you will see that this sort of demand surge lasts for 10 to 15 years easily. Considering India's population and landmass, we don't see India moving towards any different way. In fact, it will probably be a bit more exaggerated in the case of India. Considering this, even with the capacity coming in and considering the market dominance and leadership that Electrosteel has, it seemed like a but obvious decision for us to go ahead and increase capacity.
Understood. Thank you.
Thank you. Next question is from the line of Rajesh Agarwal from Moneyore. Please go ahead.
Hello?
Yeah.
Hello. So my first question is, why is there a difference in profitability between standalone and Concall? What is the major item for that?
Mr. Rajesh, see, in consolidation, we have around 10 overseas subsidiaries whose numbers are getting added into our consolidation accounts. And these subsidiaries are mainly trading arms.
Okay.
So the manufacturing, they are not the manufacturing arms, but they are just the trading arms. So most of the exports that is happening from Electrosteel Castings India is happening to subsidiaries, which is in turn being sold in the overseas markets.
Okay. So are the subsidiaries making losses because net profit has come down in Concall?
So subsidiaries are in fact profit-making subsidiaries, and it's just because of the accounting treatment that the profit in the consolidation part is appearing to be lower than the standalone numbers.
Okay. So it will always be like that only.
Yeah, it is always like that only. Whatever contra entry we are having with subsidiary company, with the holding company, it has to be cancelled. Like subsidiary company giving dividend to the holding company, that is getting cancelled. That's why there is an impact.
So for our purpose, we always have to go by Concall earnings.
Standalone number. Standalone better.
Standalone better.
Yeah.
Okay. But the market, the valuations and everything will be on the Concall, na? No,
it will be on a standalone basis only.
Standalone basis.
People will see and visit consolidated figure also, but standalone is the better proposition.
Okay. And sir, what is the outlook for the growth of volume? Will volumes grow by say, double digit this year?
Mr. Rajesh, we have Mr. Pankaj Poddar with us. He is the Executive Director and Chief Marketing Officer. He has been with the company for 25 years, and he has taken exports from almost 0 to 1,500 crores where we are now. So he will be the best person to address this query. I'll hand over to him.
Okay. Well, Mr. Rajesh, the main issue here, like when you say that whether there will be growth, there absolutely will be growth because of two major reasons. That is that the Indian market, because of the JJM scheme and the Amrut scheme, is booming. The export markets are also doing, and other than that, our capacity is going up. So because of these reasons, we will definitely be seeing strong growth numbers going forward.
Are margins better in export orders or local orders, domestic orders?
The margins are significantly better in export than in domestic.
Thank you, Rajesh. I'll request to join the queue again for a follow-up question. The next question is from the line of Saket Kapoor from Kapoor and Company. Please go ahead.
Yeah, namaskar, sir, and thank you for this opportunity. Firstly, sir, an observation from my side. Firstly, thanks to the representation from the promoter side, Madhavji, for joining the call and addressing the investors. So this was a long-pending request from the investing community, and thank you for adhering to the same, and we hope for the continuity of the same. My first question to you only, sir, is firstly, sir, to take into account the shareholder value creation path. If you could give us some understanding of what are the tasks that are still left unturned, things which are still pending for getting the right valuation for the company over a period of time. investors have not been able to realize the right value for the investment that they have made both in Electrosteel Casting as well as for Srikalahasti Pipe. However, the investors have supported for the merger that has gone through 2 years ago, but the valuations have remained more or less the same if you take a longer period time. So this is the first observation from the investing community that the right valuation, market is not giving us the right valuation. So would request the team to look into the areas and the reasons why we are not valued correctly, if I may use the term so. And now coming to my question part, firstly on the capacity augmentation from 7 to 9, if you could give how are the capacities going to kick in from 7 to 9, which year, what would be the capacity addition?
Sir, the capacity enhancement for phase 2 is going on, and we are hoping to see that come into play around the mid of the next financial year.
For this financial year, there will be no capacity addition?
No, sir. This year we will be spending the money, and its effect will come into play next financial year, please.
So for this year, there will be improvement on margins only on account of the efficiencies that will kick in, no volume growth, because we are already running at above 100%.
Yes, sir.
Okay, and when we look at now for the finance part, when we look at our the finance cost line item, that has gone up significantly. So if you could give us the breakup on how much is on account of on account of finance paid to loans to banks and other costs also, and the key reasons for the same, and the net debt number also.
Paketji, Gaurav here. So total debt has actually come down since FY22. It has come down by around 300 crores, and our net debt figure as on 31st March stands at 1800 crores. Interest has gone up to 272 crores compared to 185 crores in FY22. The major two reasons for this is one, the rise in interest rates, which all the companies have faced. The repo rate had gone up by 2.5%, and the international rates, which are SOFR rates, had gone up by around 4.5%. So we had an impact of the rising rate. And number two is the working capital requirement had gone up because last year, if you recall, coking coal prices had touched even $550-600 plus. So in spite of our total debt coming down from 31st March 22 to 31st March 23, in between the average utilization had gone up. And because of these two factors, the interest burden for the year had gone up. And as I mentioned in my earlier call also, based on the what we are seeing on the market movement, on the T-bill and the 10-year GSEC and RBI's decision to stay put on the repo rate, we feel that this has peaked out, and so has our working capital requirement. And going forward, this should come down.
Sir, just a follow-up, sir. 1800 crore is the net debt number for FY23.
Right.
And what would be our endeavor for the next year, sir? And what are the current maturities? And if you could give us some color.
Next year, FY24, we have around 160 crores of term loan repayments scheduled. And after that, following year, we have around 250 crores of long-term repayment scheduled. So these are scheduled repayments, and further movement in debt would depend on the working capital.
Okay. So any number you can share what we are looking to end the next year? It is too early right now.
Correct. So no point of going that far, but obviously, since even this year we have reduced our debt by 300 crores in spite of so challenging times. So you can understand that the idea is to bring down the debt.
So one more question I have on the bookkeeping part. When we see
sorry to interrupt you. I'll request to join the queue again for a follow-up question. A request to all the participants, please restrict to 2 questions per participant so the management can address all the questions of the participants. Next question is from the line of Jayesh Lad from Centra Advisors. Please go ahead.
Good afternoon, sir. Firstly, congratulations on such great numbers. My question was regarding CapEx. So the phase 2 CapEx which has been going on, my question was exactly at which facility is it going on, and also by what time can we expect the full capacity to come online?
So we are having expansion in both the locations, that is Srikalahasti, which is in the South India. There the main capex is happening, where we are increasing the capacity by around 150,000 tons. So right now we are at 4 lakh tons, which will go to 5,50,000 tons. This will happen by mid of next financial year. And a small increase is happening in our eastern unit. So there will be at around 350,000 tons. So altogether, in next 18 months approximately, we should be at close to 9 lakh tons.
Sure. Thank you, sir.
Thank you. Next question is from the line of Chetan Phalke from Alpha Invesco Research. Please go ahead.
Yeah. Thank you for the opportunity, sir. So my question is with respect to our exports. So this year, I think our exports have gone up from under 50 crores to, especially to US, our exports have gone up from under 50 crores to 200 crores plus. So what is the reason in this uptick? And if you can just help us understand the dynamics of the US demand supply when it comes to DI pipes. And who are we competing against in the US markets? Because I understand the players in US markets, they are making DI pipes via the scrap or the EAF route. So what is the differential in their cost of production versus our cost of production? If you can help us understand.
Well, regarding the demand in the US market, the US is one of the biggest markets for ductile pipe. And the US government has put a lot of focus on infrastructure development, which is needed by that country. And you'll be happy to note that Electrosteel is the only manufacturer that supplies to the US, that exports into the US. No other manufacturer is selling into the US other than the local manufacturers. Regarding your question on the method of manufacturing, well, the method of manufacturing can be different. It depends on what is more in abundance in what geography. It does not make a big difference. But of course, producing by the blast furnace route is not only efficient and cost effective, but is also qualitatively better. So we are positioned well in the US market, and going forward, we do expect to maintain similar numbers or improve.
Okay. So what would be the difference in the cost of production of a US player versus us? Tentatively, 20%, 30%, more than that?
So it's difficult to say or comment about the cost of production of other manufacturers, and that too in a completely different geography, in which there is a big difference in not only raw material but labor and all sorts of things. So I think it's better not to compare from that perspective.
Okay. Because sir, there is very little information available on the let's say the US consumption or Europe consumption. What is the opportunity size? So if you can help us understanding what is the size of the US market and Europe market, and how are they currently procuring their DI pipes? From where are they procuring, etc.?
The US market, as I said, is procuring most of its products domestically because they have traditionally a strong DI pipe industry, and we are the only company from which they are importing. The size of the market is almost 8 to 9 lakh tons, so it's a huge market, as I said earlier. The European market is more of a replacement market. In the last few years, it has not really grown, but it has maintained in terms of the demand because it's more of a replacement market. But recently, there has been a lot of funding coming in from the European Union through the European Commission. A lot of funding has come in because of which there is robust demand also in Europe. In Europe, we have a strong manufacturer and a couple of small manufacturers. And again, in the European market, we are the second most preferred supplier, and probably we are the only company of any significance that is supplying to the European market other than the local manufacturers.
Okay. So, sir, what gives us this advantage that we are the preferred suppliers and other players, let's say Tata Metaliks or Welspun, despite having capacity, are not able to penetrate into US markets? I mean, is it that we have set up subsidiaries since a very long time that gives us a head start, or it takes a lot of time for regulatory approvals? I mean, what is really making the difference over here?
You see, there are a host of reasons. One is our focus into the export market. Secondly, we suit our products to local needs. Thirdly, there are certifications involved. Fourthly, as you rightly said, we are present in the market, so we have our ears close to the ground. So there are a number of reasons which is, and it's difficult to attribute what percentage to what reason, but yes, we are working hard to remain one of the preferred suppliers in both these premium markets.
Thank you. Chetan, I'm requested to join you again for a follow-up question. Next question is from the line of Vikas Singh from Phillip Capital. Please go ahead.
Thank you for giving me opportunity again. Sir, regarding the capex, which you said 440 crore are yet to be spent, can you bifurcate the FY24 and FY25 spending?
It is in the process of deciding how much money will be spent in 24 and how much money will be paid in 25. But you can presume 50-50.
Understood, sir. And sir, just one bookkeeping question. Can you give us the quarterly volume for 4Q and 3Q?
Quarterly volume of DI5 for Q4, we sold around 193,000 tons.
Okay. Last quarter, sequential as well as YOY number?
YOY, it was last financial year, it was 178,000 tons.
Okay. And 3Q, sir?
Q3, it was 192,000 tons.
Understood. Thank you. That's all from my side.
Thank you. Next follow-up question is from the line of Ashraf Patel from Molecule Ventures. Please go ahead.
Sir, thank you for the opportunity. Two questions. First of all, do we use pet coke in any of our process, the entire value chain?
No, we don't use pet coke. We require coking coal.
Only coking coal. Okay. And sir, the last question is regarding that all the mine deallocation which was done by the government. Have we seen any instances where actually the after the mine is reallocated to someone else, the payment actually flows into the company?
Yes, please. There have been precedences of the same.
Sir, can you please name a couple of them?
I will have to revert to you on that, sir. I am not equipped with the exact names.
Sure. But and just to know, it has been recent? It has been off late, like over last 6 or 12 months, or it's been like that for some time now?
Sir, I do not have the exact answer to that question. I will have to revert to you on that.
Sure. No issues, sir. I'll follow up. Thank you. All the best.
Thank you very much.
Thank you. Next question is from the line of Sriram R, individual investor. Please go ahead.
Thank you for the opportunity. My question is on the industry capacity utilization. What is the industry capacity utilization, sir, for FY23, and how much capacity is coming up for the next couple of years?
Mr. Sriram, approximately total industry capacity should be around close to 3 million tons. And this industry is not a fragmented industry. There are very limited number of players, and the renowned ones which are operating at near to 100% capacity. Recently, new plant has come up which is of Welspun Corp, but I'm not sure at what utilization they are working. Not 100%, that is sure. And during this financial year, which is going on, I think only maybe 1 lakh tons or 2 lakh tons might come up. New capacity might come up, not more than that.
But you're saying the existing capacity is running at 100% for all the players, right?
Not all the players, the renowned ones. The other ones, the smaller ones, I think are not operating at 100%.
Okay, so overall, I just want to get a sense, like how much it will be, like 80% or?
Capacity is 3 million tons, so you can say at around 80%.
Okay, thank you. And so just one more question. On slide number 15, you've given that DIP pipe is expected to grow at 11 to 13%. So just want to know from where you got this data from.
This is our estimation, and this is based on the past trends. If you see data of last, say, 5 years, 10 years, 15 years, you'll find that industry has grown at a much more rate than that. And with all the schemes which are being promoted by the government, both the central government and state government, we are hopeful, and this is our internal estimation, that this would be kind of growth that we would see in coming years.
Okay, that's very helpful. Thank you.
Thank you.
Thank you. Next question is from the line of Vijay Agarwal from Federal Bank. Please go ahead.
Yeah, sir. Just I wanted to know that company has to incur capital expenditure of 440 crore. Then how it will be funded? Then what will be the debt mixture of this capital expenditure?
Mr. Vijay, this would be mostly funded out of our internal sources. And if required, we might, the debt is tied up. If required, we might go in for a small debt, but mostly out of internal sources.
Okay, sir. Thank you.
Thank you.
Thank you. Next question is from the line of Saket Kapoor from Kapoor and Company. Please go ahead.
Ji, sir. Thank you for the opportunity. Sir, in your cash statement, we find the 3 line items. Firstly, the sundry write-off balances of 29 crore, provision for absolutions of inventories to the tune of 24 crore, and provisions for regulated reserves and other risks to the tune of 18 crore. If you could explain the nature of the same. I think so regulated reserve is the line item that has appeared for this year. It was not last year there was a competitive number.
So, Mr. Saket, 28 crores write-off, if you remember, that had happened in the first quarter, which was on account of one of our railway siding.
Okay, sir.
Yeah.
Or inventory is absolute.
Which one?
Yes, sir. Baki 2 points, provision for absolution of inventories. We have also absolute inventories to the tune of crore. So what is the nature of this absolution and why this has occurred? 24 crore rupees. And also on the regulated reserve and other risks, we have provided for 18.38 crore.
You're talking about the standalone number?
Sir, I am talking from the consolidated statement of cash flow.
This is dividend.
18.38 crores is on account of the dividend part. As we told that dividend has come in from the subsidiary to the standalone company, to Electrosteel India. So it has come out of the reserves. So that is why that number is reflecting there.
Okay, and for the inventory absolution, sir?
Whatever material pipes we are selling to the international market, we are selling to subsidiary companies, right?
Yes.
And whatever stock is lying on the year end and at the subsidiary level end, that profit component has to be knocked off in the consolidation level as per the accounting practice.
Sir, didn't get you, sir. Come again, sir. What you are trying to explain?
Mr. Saket.
Yes, sir. Please.
We are selling from India to international company, right?
Right, sir.
International company is the buyer for us. But when we are consolidating the account of subsidiary company with the holding company, whatever stock and sold stock is lying in the subsidiary company has to be knocked off with the holding company in the console figure. So whatever unsold pipes are lying in the subsidiary company level, the profit component has to be knocked off. There is no actual profit, na?
No, sir. Here you are going for absolution of inventory. This means that these inventories are no longer needed. So this is the explanation for it.
I will come back to you, Mr. Saket. You will get a phone call from me.
Okay, sir. And lastly, about the share application pending, Madhavji, if you could give us some color, what is the timeline from the promoter end of putting up the balance 75%? And also, one question to CFO sir about the ICD closing balance. What is the closing balance as on 31st March for the ICD that we generally used to give?
ICD balance as on today is 9 crores only, and that will be, we are hopeful that it will come on time, hopefully by June end.
Okay.
And all the money already came back.
Okay. And we will discontinue also with this business of ICD.
Yeah.
Correct, sir. And Madhavji, if you could give us some timeline on this pending amount on the share application money.
So the timeline for the remainder of the money for the share application is around 18 months from the date of issue.
Yes, sir.
So in that due course of time, we will be infusing the remainder of the capital.
Okay, sir. And for the value creation idea, sir, what is your thought process, sir? And what steps should be taken going ahead so that investors' value to be created? You can understand from the market capitalization and the way a market perceives a company. So what is your thought process, sir? And what steps are you taking to reward your shareholders who have been there in the thick and thin time, good and bad time with the company?
Sir, I think there are two parts the answer to that question. With the compensation of the coal mine coming in and with the fructification of the capital expenditure that the company is undertaking this year and next year, which will take us to 9 lakh tons, I think there will be good value creation from both these exercises for the organization. And in regard to the shareholders, I think we have announced we've announced a dividend of 90% this year, which is more by 10% from the last few years, and we're hoping to continue with that going forward.
Thank you. Next question is from the line of Miraj from Marian Capital. Please go ahead.
Hi, thank you for taking my question. I just had one clarification. In one of the answers to the earlier participants, you mentioned a figure of 8 to 9 lakh tons of market in US. If you could just explain, I somehow missed or misunderstood something. If you could just explain that again.
So that is the size of the market in the US. The American market annually demands approximately 8 to 9 lakh tons of DI pipes. So that is what I said in terms of the demand in the American market.
Okay, understood. And if the 8 to 9 lakh is annually required, would you be able to tell us what the market size would be in US, rough figures if you have any?
Sorry, come again. Could you please repeat the question?
The size of the market in US?
So this is what I said. That is the size of the market in the US. I mean, the demand of ductile pipe in the US is the size of the market in the US.
Okay. Got it. Okay. Thank you.
Thank you. Next question is from the line of Sriram R, individual investor. Please go ahead.
Yeah, thank you for the opportunity. So just continuing the question asked by the other participant on the shareholder value creation. If I look at your numbers, we are like 7% ROE and we are operating at 100% plus capacity. So like what is your target ROE, few years from here on? What are the steps that are going to be taken to improve this?
Hi, Shreya. So, point one on ROE or CD, you have to look at adjusted ROE because our compensation, which is yet to come in, is also being used for calculation of ROE, which is impacting the ratio. So if you see adjusted ROE, it will be around 11%. And with the expansions that are happening, in the coming years, definitely the profitability would increase and the return ratios would appear much better.
This is on account of, you're saying, purely capacity increase.
Right.
Okay. Thank you. All the best.
Thank you. Next question is from the line of Kumar Keswani from Strategic Advisory. Please go ahead.
Hi, good evening. There was a question made that we should be looking at standalone and not consolidated accounts. Given that all the export sales of the companies are routed via the subsidiaries, I think it's important for us to look at consolidated and not individual accounts, number one. And number two is that from a company's perspective, the point about shareholder value creation has been made. We leave it to the company to look at it, and I think this is one area we should look at, because as investors, we look at consolidated accounts given that there's a lot of intra-company sales.
Your point is correct, but point is that whatever the subsidiary company is getting the material, the pipes, which all are exported from India only. So we have already considered the export in Indian balance sheet, Indian accounts. Same thing is getting exported through or sold domestically in the international market. That is why we were suggesting, and all the bankers or the investors are considering standalone balance sheets for the valuation purpose. If you want to consider console, we have no objection that you can consider, but for better valuation, it is advisable to consider standalone.
Mr. Keswani, the idea is, so ECL India is a manufacturing company, and so you will have to do valuation for a manufacturing company based on the standalone numbers, and our subsidiaries are trading arms. They are nothing but marketing arms which are supporting for selling of our products. So then if you take console, you are basically mixing a manufacturing company with a trading company. That is why we are suggesting you to consider standalone numbers, because that will give you a better picture of the business.
No, I completely understand the point that is being made. I'm just responding to the comment that from a company perspective, the moment you get into console numbers, common entries get adjusted. One of the people on the call went into great depth to explain, why the raw material movement and prices had to be knocked down, and as a result of which there was a line item in the balance sheet. The point I'm making is that as an investor, the moment you're doing sales from one entity to another, it's always better for the company as well to start looking at consolidated accounts and try and work towards that picture, because one is a manufacturing arm and another is a sales arm. You need to look at it together, not individually.
Well, Mr. Keswani, I would like to, as a matter of information, tell you that the subsidiaries, the trading arms that Gaurav was talking about, have done record profits in this financial year. They have done much better than any of the earlier financial years. So now, considering the adjustments that have to be made, the numbers look a bit skewed, but once you have the detailed balance sheets going forward, you will be able to see it whatever way you want.
Okay.
Thank you very much. Ladies and gentlemen, that was the last question for today. And I'll hand the conference over to the management for closing comments.
I would like to thank all the market participants, and we look forward to a good year ahead. Demand is robust. We are well equipped in terms of market position. With that, I would like to conclude this year's earnings Concall. Thank you very much.
Thank you very much. On behalf of Electrosteel Castings Limited, that concludes this conference. Thank you for joining us. You may now disconnect your lines.
Thank you.
Thank you.